Okay, let's get right into it. We're here today because we believe eBay's public success story is built on a foundation of carefully engineered reality. This explainer is going to break down how the company's financials appear to be manipulated, how it profits like an unregulated bank, and how it may be breaching a fundamental legal trust with its users.
Here's how we'll lay out the case. We'll start with the story eBay tells the world, then dig into the accounting tricks that prop up their earnings. After that, we'll look at how they're profiting from sellers' money, the real-world nightmare this creates for users, the specific laws they appear to be breaking, and finally, why regulators need to step in.
All right, first up, the public narrative. This is the polished, tech-forward story that eBay sells to Wall Street and the public.
Now listen to the language they use in the reports. Words like magical, AI-driven insights. This isn't just marketing fluff. It's a calculated strategy to position themselves as a high-growth tech company, not just an old-school marketplace. And you know why? Because tech companies get much higher valuations.
And guess what? It worked. Big time. After a strong earnings report in Q2 2025, the stock shot up almost 23% in a single day. That's the power of a good story. You create a headline that the market loves, and the hype machine does the rest, whether the fundamentals actually back it up or not.
But here's where the story starts to fall apart. You go look at what actual users are saying on forums, and that magical AI is described as a fixed decision tree that is rage-inducing. This isn't just a few unhappy customers. This massive disconnect suggests that the company's core technology has been materially misrepresented to the market.
So that brings us to the big question. If revenue growth is basically flat, how is eBay pulling off these impressive earnings beats that get the market so excited? Well, the first tool in the toolbox is pure financial engineering. It's a classic accounting move, and while they disclose it, it smells fishy. So, get this. In 2024, eBay decided its servers and networking gear would suddenly last longer. They changed the depreciation schedule from 3 years to 4. Think about that. At the same time, they're telling everyone they're a leader in AI. They're saying the core hardware for that AI is going to last 33% longer. It just doesn't add up.
And here's the payoff. This one little change, which has nothing to do with selling more stuff, slashed their depreciation expense and instantly boosted net income by $58 million. That adds a clean 12 cents to their earnings per share. Now, any sharp analyst is going to back that out, but the headline number is what the public sees, and that's what drives the hype. It's a textbook way to manufacture an earnings beat.
Of course, eBay has its official justification. This is standard corporate speak you'd expect to see. But come on, you look at the timing, you look at the impact. This is a classic move to manage earnings and hit a number to keep that stock price story going.
But the accounting change is really just an appetizer. The main course, the real hidden earnings engine, is far more systemic. We believe eBay has effectively become an unregulated bank, using its sellers' money as capital.
And they do this using something called financial float. Basically, it's the mountain of cash they hold on to between when a buyer pays and when the seller actually gets their money. In today's interest rate environment, that giant pool of other people's money is a goldmine for earning interest.
And we're not talking about pocket change here. Look at these numbers. As of the second quarter of 2025, the interest eBay earned on this float made up nearly 10% of its entire pre-tax income. That's a huge, material chunk of their profits coming from something that has nothing to do with their core marketplace business.
This forces us to ask a really fundamental question. When almost a tenth of your income comes from investing your customers' funds, are you still just a marketplace? Or have you, for all intents and purposes, become an unlicensed financial institution? We'd argue this reliance on float is a material misrepresentation of their business model to every single investor.
Now, this financial strategy isn't just about numbers on a spreadsheet. There's a real human cost. The company's incentive to hold on to that cash for as long as possible creates policies that directly harm sellers. Let's look at a case study. This story starts with a completely legitimate sale of a high-value item, a used graphics card. The seller in Canada was totally upfront about its condition, disclosed some cosmetic flaws, and shipped it off to a buyer in Florida.
So the buyer gets the card and then initiates a return. But look at what came back. The original card had visible heat stress and melted plastic. The return card? A pristine connector, shiny, straight pins. It's obvious what happened here. The buyer stripped the good card for parts and sent back a broken shell. It's classic return fraud.
As the seller puts it perfectly, melt marks don't disappear. It's physically impossible. And despite having clear photographic evidence of the fraud, eBay sided with the buyer and forced a full refund. The seller lost everything. And the most telling part, eBay kept its fee from the fraudulent sale. This isn't just a one-off error.
It's how the system is designed to work.
And this systemic pattern, where sellers are forced to eat the cost of fraud, leads us directly to what we argue is eBay's single biggest undisclosed legal liability: its role as a trustee.
See, in places like Canada, when a marketplace like eBay steps in to collect and remit sales tax for its users, the law gives them a very specific title. They become what's known as a deemed supplier. And that title comes with a massive legal string attached. It's not optional. The moment they start collecting that tax, the law irrevocably imposes the duties of a trustee upon them. By law, they are legally responsible for that money in the same way a trust fund manager is. Now, I know what you're thinking. eBay's user agreement says they're not a fiduciary. Well, that's legally irrelevant. You can't write a line in a contract that says a federal law doesn't apply to you. It just doesn't work that way. By choosing to collect tax, they accept the legal duties of a trustee. And one of those core duties is that you cannot mix trust funds with your own money and profit from them, which means their entire float operation could be in direct violation of the law. So let's connect all these dots. These aren't just separate, isolated problems. This is a coherent strategy, built layer by layer to materially misrepresent the company to the market. It's a four-step playbook. First, you create the hype with a flashy AI story. Second, you engineer the earnings with accounting tricks to make the story look real. Third, you prop up the whole thing by extracting value from your users' money, your float. And fourth, you make it all possible by operating as a legal trustee while pretending you're not, which lets you profit from those funds. Each step feeds the next. So in conclusion, it's our view that eBay's public filings are materially misleading. The quality of their earnings is artificially inflated, and their balance sheet is carrying a massive, undisclosed legal risk from their float operation. The gap between the story they tell and the way they actually operate is a chasm, and that leaves one final question. Who's responsible for turning on the lights? We believe the evidence demands regulatory action.